In modern financial reporting, a signed legal document does not equal a contract, and an issued invoice does not equal revenue. Historically, commercial teams viewed revenue through the lens of pipeline status. A booking was made, a milestone was reached, and a bill was scheduled. Accounting departments then attempted to translate those events using a fragmented web of industry-specific rules. The result was highly inconsistent financial statements, where identical economic realities produced different reporting outcomes. IFRS 15 replaces that fragmented landscape with a unified framework. The analysis relies strictly on economic substance, regardless of whether a company builds bridges, develops software, or sells retail subscriptions. The standard revolves around a single core principle. Revenue must accurately depict the transfer of control of promised goods or services to a customer. And it must do so in an amount reflecting the consideration the entity actually expects to be entitled to in exchange. To execute this principle, the standard requires a specific analytical grammar, the 5-step model. The foundational steps at the bottom bear the weight of the entire structure above them. This model is strictly sequential. A misjudgment made early in the process creates an inescapable chain reaction. If an entity fails to properly identify the contract or isolate the specific deliverables, the downstream calculations will inevitably corrupt the balance sheet, distort the timing of recognition, and invalidate corporate disclosures. Step 1 is the absolute baseline threshold. Before any revenue analysis begins, an arrangement must pass through 5 cumulative criteria to qualify as a contract. An oral agreement or an implied business practice can meet this threshold, but enforceability is the non-negotiable requirement. Paragraph 9 establishes that the parties must have approved the arrangement and that their respective rights regarding the transfer must be identifiable. Furthermore, the payment terms must be identifiable, and the arrangement must possess commercial substance. Commercial substance dictates that the risk, timing, or amount of the entity's future cash flows will actually change. A paper arrangement without real economic effect fails the test. The 5th and most sensitive prerequisite is probable collectibility. The entity must establish that it is probable it will collect the consideration to which it is entitled. This is a specific test at inception to determine if the model activates at all. It is separate from the IFRS 9 impairment testing used to evaluate credit losses later in the reporting cycle. Once the threshold is crossed, preparers must apply the anti-fragmentation rule found in paragraph 17. If a customer signs multiple side letters or purchase orders that were negotiated as a package with a single commercial objective, those documents must be collapsed and accounted for as one single arrangement. Step 1 exists to prevent businesses from recognizing revenue based on commercial pipeline hope. It ensures that the model only activates when true legal and economic enforceability is established. With the contract identified, the analysis moves to Step 2 to determine the true unit of account, the performance obligation. A performance obligation is rarely identical to a commercial billing line. Marketing materials or proposals often list tasks that do not transfer a separate good or service to the customer. Conversely, standard service practices or published policies can create implied promises that hold the entity to obligations never explicitly written in the legal text. To isolate the actual deliverables, the standard relies on a rigorous 2-limb distinctness test. Limb 1 requires the item to be capable of being distinct on its own. Limb 2 requires the promise to be separately identifiable within the context of that specific contract. Paragraph 29 provides indicators that force bundling. First is significant integration. If the entity integrates goods into a combined output, distinctness fails. The second is significant customization. If bespoke software permanently modifies a base product, the components merge into one obligation. The third indicator is high interdependence. If the entity cannot fulfill its promise by transferring each item independently, the items form a single unit of account. These rules neutralize severe reporting risks. Over-separation accelerates revenue artificially by treating integrated tasks as if they were finished standalone deliveries. Over-bundling creates the opposite distortion. It improperly defers revenue and obscures the true margin profile of the individual contract components. The distinctness test serves as the ultimate defense mechanism. It strips away creative commercial packaging and forces the financial statements to reflect the actual economic promises being delivered. The unit of account defined in Step 2 becomes the frame for every subsequent judgment in the model. Step 3 determines the transaction price. Nominal invoice amounts must be adjusted for economic reality. The entity must evaluate variable consideration. This requires estimating the impact of performance penalties, volume rebates, or anticipated price concessions. This calculation is bound by a strict reversal constraint. Variable pricing enters the transaction price only to the extent it is highly probable that a significant reversal of cumulative revenue will not occur. Step 4 allocates the adjusted price. The distribution cannot be arbitrary. The total consideration must map strictly to the standalone selling prices of the performance obligations identified back in Step 2. Finally, Step 5 assesses the transfer of control. This trigger point requires evaluating specific indicators to decide if revenue is recognized as a progressive over time measurement or a point-in-time delivery. Steps 3, 4, and 5 represent a second layer of technical discipline. They take the architectural units established in the early stages and subject them to a rigorous process of measurement, allocation, and trigger assessment. In operational reality, the 5-step model is highly iterative. It is not a static checklist completed once at contract signing. Commercial arrangements evolve. Contract modifications, change orders, and scope creep force a reassessment of the entire chain. This creates a systemic data architecture crisis for many organizations. Legacy ERP and accounting systems were simply not built to execute IFRS 15. Standard billing modules trigger revenue based on crude delivery status codes. They are entirely blind to two-limb distinctness tests or variable consideration constraints. The result is a severe data disconnect between the sales team's CRM software and the finance team's general ledger. Implementing this standard requires a strict governance imperative. Cross-functional alignment is mandatory. Legal, sales, IT, and finance must abandon their operational silos and share a single, unified data architecture to track contractual truth. Relying on fragmented data silos guarantees manual workarounds, heightens audit vulnerabilities, and ultimately leads to compliance failure. IFRS 15 is a discipline of economic reading. The standard forces a business to abandon the simplistic question of what it billed and instead answer the definitive truth. What did the customer truly buy, and when did they gain control of it?